All right, so we are now live on TikTok as well as YouTube. We're going to wait a few moments just so people come into our live stream if they want to ask any questions. They have some kind of 2 cents that they would like to add in or whatever they'd like to talk about, engage. That's why we're waiting for a few moments. And then we're going to jump right into the video. We are going to be looking over the economic data that came out for Tuesday. Little bitty PMI numbers actually absolutely destroyed the forecast. It's 58.2, which is way above the expansion limit of, I guess, 50%, or like the point in which it becomes an expansionary number, and then under 50 would be contraction. So we will start this very shortly, and let's get the recorder, and we'll go in this video right now. Also, if you do have any questions, you can put them in the comments section below, and I will be going over the questions throughout the video. Whenever we switch from one asset to another, we will be going over the questions. So if you have any, definitely don't hesitate to drop them in the comments. All right, let's get this going. Get the recorder. Hey traders, welcome to another global macro update. We're first going to start this video by looking at the economic data that came out for Tuesday. Got the job opening number for the United States, beat the forecast at 5.4 million. And then we also got some PMI numbers for Canada, and they didn't really see a forecast, I guess, but it was at 58.2. And then if it's anything over 50, it's an expansion. It means that it is a positive outlook. And then if it's under 50, it would be a negative outlook. So we see that these PMI numbers, for example, US, GBP, or UK, as well as Canada, they're all positive. The PMI number, the Purchasing Manager Index number, is positive, meaning that it's an expansionary phase and it looks more bullish. So we will see how that goes, but in terms of what it looks like right now, there is more optimism, there is more hope, and there's a little bit more certainty in the current market environment, is what we're gathering from the economic data that is currently being posted right now. So we got our first question on TikTok. Also, if you do have any questions, just drop them in. The question from Little Wilfred says, opinion on hyperinflation and USD. Good question. A lot of people are talking about the worry of inflation and hyperinflation within the United States and really all around the world because central banks are printing lots of money. Well, really good worry, and it's understandable, but there is two major factors in inflation and hyperinflation. The one is the expansion of the balance sheet or increase of the monetary base, basically printing more money into circulation from thin air. That's the first step in the formula for inflation or hyperinflation. The second step that is less known would be the velocity of the currency, which also means how many times that currency is transacted in a given time frame. And when these two things are put together, then you get inflation. But it's not just the expansion of the balance sheet. So right now, what we can see is, let me pull it up right now, the velocity of currency in the United States is dropping substantially since the 2000s. And this is offsetting the inflationary pressure provided by the expansion in the balance sheet. So that's why we're not seeing as much of the inflation that, for example, Peter Schiff thought when they first created the quantitative easing, because obviously expansion in balance sheet should create inflation, but we see since the 2000s, 1997, 1998 was the peak of the velocity, and we've seen it go down since then. And another really great chart to look at really quickly is going to be the Japanese velocity. Oh, let me just find it. Japanese yen velocity. And the Japanese yen, I don't know if I can find it right now. The Japanese yen is in a very interesting spot because we see that America has printed lots of money and their velocity is dropping, but Japan has printed way more money. I'm trying to find it here. Give me one moment. I didn't think I was going to be talking about this, but this is very important stuff to be going over. Give me one moment here. trying to find the Japanese monetary base burst. There we go. Perfect. All right. So this is the Japanese monetary base. We can see that Japan has printed a significant amount of money compared to America. This is the US dollar. This is the Japanese yen. So you would think naturally that Japan has a lot more inflation and there's a lot more worry about hyperinflation. But what they've actually suffered through since 1989, somewhere around here, when their asset bubble collapsed, is deflation. So their Japanese yen is getting stronger, and the monetary policymakers in Japan, the Bank of Japan monetary policymakers, they are fighting deflation for the past, let's say, 30 years, really, where they're trying to create inflation, trying to create some sort of move to the upside in terms of CPI numbers, and they're not able to get it. And why is that? Their velocity of their currency is dropping. It dropped more than half from, I believe, 1990 to the 2000s. So we see that the velocity for the US dollar is dropping. But if this continues, and if the velocity of the currency drops and it doesn't stagnate and move to the upside, I don't think there's a massive worry for inflation and hyperinflation just yet. Also, on a side note, there is another significant pressure that is added onto the deflationary basket, which is the demographic cycle, pyramid, whatever you want to view it as. But Japan is a really good guinea pig, I guess you could say, for this, because Japan is around 20 years ahead in terms of their demographic cycle. On average, they have their average age that is 20 years older than the Americans. So they have a lot more retirees. They have a larger baby boomer generation that is soaking up more of the healthcare, the savings, and they're not really spending much money, because if you don't know how long you're going to live, and if you only have a certain pool of money or assets, you're going to conserve because you have no idea how long you're going to live. And that is deflationary. You're not spending money, you're not creating aggregate demand, and you're not transacting currency, yen, dollars, whatever it is, in order to increase the velocity. So there is significant deflationary pressure put on currencies such as the United States dollar and the Japanese yen. And I think Japan is a great example of how central banks can print a tremendous amount of money, but as long as the velocity of the currency is dropping, that is going to somewhat offset the expansion of the monetary base or the amount of currency in circulation. So hopefully I gave you a little bit of information on that. We do talk about this quite extensively because a lot of people assume increase in monetary supply, automatic inflation, and that's not really the case. You need to see the increase in velocity before you get the actual CPI numbers to go up, which is Consumer Price Index, which is going to be the average cost of goods and services in a basket, basically. And that's going to be what we're going to be looking for in order to see if there is inflation or not. So, opinion on U.S. passing 26 trillion in debt and still spending money on wars. So, yeah, like I said again, actually, I have a really good picture here. Give me one moment here. Inflation compared to, nope. So give me one moment here. I'm trying to find a really good chart here. Monetary base. I'm trying to look for historic inflation or historic federal funds rate. Because that will give us a really good long-term, perfect, this is it right here. Sorry it's taking a little bit longer, but we're not really normally talking about this. I didn't really expect it, but this is still really good information to talk about, and that's why we're going through it. This is a live, this is a recording, so we will go through timestamps and make sure that you can select where you want to, what you want to view when you are looking back at this video. So this is a really good example of what I expect the potential next handful or couple decades will be looking like. Your question is, what about the debt and the money spending, the money printing on wars? Very similar situation, right? So you got the Great Depression, World War I, Great Depression, World War II, right? So obviously there was a market meltdown and they needed to create stimulus. They needed to create aggregate demand. So what did they do, right? They dropped interest rates to the lowest it's ever been, around 2%. Now what this did is get themselves out of the Great Depression. They also went in World War II in order to create aggregate demand for really anything involving wars. Obviously, there's a lot of production in that, so that's kind of how they got out of it. But what I want to specifically focus on is the fact that it went from an extremely low interest rate at around 2% for, let's say, an entire decade almost, which created massive expansion in credit. And then what that led to is a lot of corporations assuming that easy money will continue. And then there is obviously people borrowing more. And once that happens, the velocity starts to increase. Things get a little bit better. And then once that velocity starts to increase, what happens? Inflation comes into play, right? This entire time during the 20s, 30s, late 20s, 1929 was the bust. Since the late 20s all the way into the 50s, they were dropping interest rates, right? It was easier and easier to borrow money and to get money. Money creation was super easy. So that led to, obviously, more money in the overall monetary base, right? Credit expansion is still increased currency in circulation. So during this time, there's a lot of money creation. What happened after? Well, there was inflation, right? There was worries of inflation. What does the government do when there's worries of inflation? They can really only do one thing. And this is a very hawkish policy that they would implement, is by raising interest rates. This allows them to decrease credit expansion because it's harder for people to get a loan and it costs more to borrow money, which is less incentivized by obviously going to the downside where it's easier to get money. And then central banks really only have two options. They either let inflation go wild, which is obviously not a positive thing, or they raise interest rates to combat inflation, right? So if they raise interest rates, usually markets do not take that very favorably. No one likes a hawkish policymaker because they are going to create less stimulus, they're going to potentially increase taxes, and they're going to not be spending as much money, and they're going to try to conserve. Whereas if you have a dovish policymaker, they're going to try to expand the balance sheet, create more aggregate demand through printing more money, and just give. And who doesn't like that, right? So to answer your question, in this current time, we are in around the extremely low interest rate time. And I think we will come to a point once the velocity starts to shift and there is increase in the transaction of dollars, which I think will inevitably happen. Once that comes into play, once that velocity starts to bend upwards, then you will start to see inflation and you will start to see the CPI numbers go up, and then central banks will have to act. How will they act? They will increase interest rates. The federal funds rate will increase, and markets will not take that too favorably. Look what happened in 2018 when they increased the interest rates from basically 0% up to around 2.5% after the great financial crisis, right? In the end of 2018, stock markets absolutely crumbled. And that's, I think, what will happen in the future, is we will get to a point where inflation is increasing and the policymakers have to choose. Will we keep this inflation going? And a lot of people are going to get upset because they're losing value, they're losing purchasing power, or they're going to try to curb inflation by increasing the interest rate, which will basically collapse the stock market, in my personal view. Or at least create a very long consolidation that we had from 70s to 80s, where we did not see a higher high. It was just completely flat. There was not much appreciation going on. But in that time, when there is worry of inflation, there's other assets that are extremely appreciating. They are doing extremely well. And those are the fixed supply assets that are basically immune to inflation via people wanting to create more demand and just printing it out of thin air. Gold and silver, you can't print out of thin air, and those are the types of assets that explode during worries of inflation or monetary uncertainty. And BTC and overall crypto markets, I think, will fall into that category later on. But right now, they are considered by global investors a risk-on instrument and asset that is positively correlated with traditional indexes like the S&P 500. So that's currently how I view the market. So hopefully I answered your question, Little Wilfred. A lot of information thrown at you. I understand that. If you do have any more questions, definitely let me know. But in short, I do think that there will be inflation and potentially hyperinflation if central bankers don't raise rates, but I don't think it's there yet. I think that we do need to have an increase in velocity first, and I think there is right now more deflationary pressure than inflationary pressure. So I do not expect to be having some increasing inflationary CPI numbers for, I don't think, this year. I just think it'd be more deflation than inflation. But that's my answer. Obviously, it's a speculation, but that's the way I'm viewing the market as of right now. All right, so that was a little bit of something that I wasn't going to talk about, but that's okay. That's why we have these lives, is so people can ask questions and we can go over different economic theories. So we're now going to go over some stuff involving the global restaurant industry. This reflects a comparison of year-over-year seated covers, demonstrate where we are seeing recovery start to take shape. So basically, if it's 60%, it's 60% of 100% that we previously saw last year, right? Same day in 2020 and 2019. So, in 2019 of July 6th, we were at 100% and now we're at 60. But what we can see is things are starting to pick up. Mexico obviously is not doing great at 32%, but places like Germany and, we see the DAX do much better than the UK's FTSE. And, stuff like this kind of makes sense. And it's all kind of coming together because Germany is seeing a lot higher percentage in terms of the bounce back of restaurants compared to places like the UK, which is at 68, or Canada at 64. So we can see the indexes are somewhat correlated with how positive the lockdowns and coming out of the lockdowns are for different countries. But we definitely still see that it's not back up to 100%. Germany actually did have one day that they were basically at 100%. If we go back a little bit, on June 11th, they were at 100% capacity from 2019, or a comparison. But it's getting a little bit better, but it's definitely not at a point where we can say that hotels, restaurants are back up and running at their usual speed. It looks like on average, mid-60s%, which isn't great, but it is better than what we saw back in early June, where it was at like 50s and 40s and even 30s when we're going back to May there. So looking better, but it's just some information that I think is good to know. Something that's a little bit surprising that I saw is Toronto's housing shrugs off pandemic as price smashes records. So home prices climbed to a record high in Toronto last month, and the local real estate board suggested that there's no end in sight with plenty of buyers hunting for a home. So it's not just the equities markets that are seeing a rebound, but it's other assets like real estate that is bouncing back quite quickly and quite aggressively, not really getting hit hard by the pandemic, though it seems. What I am a little bit worried about is going to be the default rates for mortgages from banks, but that's going to be, I think, a little bit later in 2020, where we're not really seeing the default rates skyrocket to a point that we saw back in 2008 to 2009 during the financial crisis. But we are keeping an eye on that, but it's just not something that is going to an extreme just yet. So real estate, stocks, overall, investors and speculators are looking at the overall market in an optimistic kind of way, which is a little bit surprising, but that's why we do the global macro update. That's why we look at multiple asset classes. We're not just looking at the S&P 500 and basing our thesis and our hypothesis off of one chart. We go through all the different market class or asset classes, and we try to base our understanding through multi-asset analysis. Also, something that is pretty interesting that I found, China told citizens to buy stocks, boosting markets. We have the Fed, meaning America has the Fed. China has its state media. Stocks globally surged as prospect of an improving China, but they were also supported by stimulus from the world's central bank. So we see governments and central banks all over the world. In China, it's mostly governments creating media, it's state media, and then in central banks for the Fed. But overall, governments and central banks are trying to support the financial markets, and they are, right? And we're going to be looking at a Chinese stock market index and seeing the absolute boom that it had recently, and looking at the past, seeing what potentially can happen in the future, because it does look like it could potentially be setting up for a pretty significant move to the upside. Quick little thing to end off. Potentially TikTok could be banned in the US. We don't exactly know, but we will see how this goes. We do have a TikTok account, obviously, if you are watching on TikTok. So hopefully this does not come into fruition, because we like the app. It's provided us some good exposure, but if that is the case, obviously that sucks. But people will go on to things like Instagram and other social media services. It's not the end of the world. All right, so now that we have done that, we're now gonna look at this chart, the Chinese stock market. So this is just one of the SEC composite indexes, and this is a 2-day chart. And if we really look back, it's extremely volatile. Yes, we are making higher lows, but look at these massive pushes right here. We got a descending wedge, massive bullish run, like unbelievable. 300%, right? And then another bullish run, 121%. And it looks like we're getting our next massive move here, where we got a nice symmetrical triangle breaking to the upside, broke that descending trend line and the resistance, and now we are in a massive impulse push to the upside. And if China and if their media keeps on pumping the stock market bull run and trying to create demand or FOMO, I think this will just continue to go up. I don't exactly know what happened during all these, but man, look at it. Like, it can run. So I'm not trading this, but it's just an overall good understanding of global indexes, because if this is absolutely ballooning, that's definitely a risk on indication. So I'm just going to go back to the VIX, because this was the VIX initially. Go back to the 1 hour and start the global macro update like we always like to do, starting off with the S&P 500. So let's open this up here and make sure that there's no questions, and then start the video. Making sure there's more questions on YouTube as well. Perfect. Okay, so we were here last time, just in that nice little tight consolidation. We did get an attempt to make a higher high. We failed, and now we're testing our previous resistance as a new level of support. We did talk about this potentially being a new level of support. We did not validate it at all for support when we initially had our impulse push to the upside. So this could be the higher low we're looking for, where we see higher low, and then a higher low here. And this is that resistance that rejected the price multiple times, where we're going to be looking for a new level of support to hold the price. So we're just consolidating right now. We've been in a nice risk on environment for a while, and we're still breaking resistances, holding supports. We have not broken the support yet. So in my personal opinion, we're still on the move to the upside, and I think that it could continue. If it does move to the downside, breaking this around 3160 support, obviously that could be a potential head and shoulders, where we got the head right here, the left shoulder right here, and the right shoulder right here. And let's just zoom in a little bit closer. And this would be the potential reversal pattern. If this does come into fruition, that would obviously mean it could be a reversal. So here's that neckline where you have the armpit. So you need to see the price come down, retest this resistance at around 3160, and then move breaking the 3120, and that is going to be your head and shoulders structure that you'd be looking for. And then if you want even more confirmation, we do see a nice ascending trend line that is connecting the higher lows, especially well respected, where you see 1, 2, 3, 4 rejections, and then we have that symmetrical triangle that is pushing the price to the upside, which is carrying the momentum up, which I think will continue. I think it's that higher probable situation. But if it does move to the downside, we could potentially be looking for this to confirm, like so, and then you'd be looking at a potential head and shoulders, and then if it breaks this zone, that's even more of a confirmation to move to the downside. But if we don't see that, I still see the market move to the upside, creating higher highs and higher lows. And if we do look on the smaller time frame, we did see a higher high, and now we see a lower high, but we are holding this previous resistance very well for a new level of support. We could see a little bit of a dip like this, But overall, I'd like ideally to see the price hold above this key zone right around here. I don't mind if it makes a descending triangle formation like this. That would actually be a nice structure to be looking for a potential long, because that would be a squeeze between the horizontal zone of support and the descending zone of resistance, squeezing towards the apex. You're looking for an impulse move to the upside, a correction to validate the previous resistance as a new level of support, and that will give you a high probable, dependable trade to move to the upside, in my personal opinion. So we'll see how it goes, but that is my view of the overall S&P. We will get a better understanding of risk on, risk off sentiment when we do look at the other indexes in this particular page here. So we're now going to quickly look at the VIX, which is the volatility index. We see that volatility is increasing slightly here, and we're still in the fading where we're not really able to pass a resistance. And we see that these just consolidations start, and then we'll get another drop off, and then we'll make it another drop off. If it breaks $30, that would be a shift where we might have to be looking at a risk off environment, because volatility is increasing. If volatility is increasing, overall, global investors are worried, fearful, anxious, and they will seek risk off exposure or instruments to park their capital. Whereas if volatility is decreasing, they're more likely to be taking on more risk and have a higher risk tolerance. So the fact that this is going up gives me a little bit of indication that we are leaning a little bit more towards a risk off sentiment, although the overall trend is looking still very risk on. Russell 2000 has not moved much at all. We do see a head and shoulders like here. So let's just zoom out and move this. This is the head and shoulders that we currently see for the Russell 2000. Obviously, it has still not broke yet. If we break the 1460 zone for the resistance, that would invalidate the head and shoulders. And if we break the 1365-ish zone, that would complete the head and shoulders. And we're not going to be trading the Russell 2000, but it's a really good indicator, in my opinion, for the speculators, for the small caps, not just the large giant tech companies like the NASDAQ. So just by looking at the NASDAQ and S&P and Russell 2000, we see that large capital flows are mainly funneling into large tech conglomerates like the NASDAQ index, which is basically what you're going to want to be looking to invest in if you want those stay-at-home companies, the Netflix, the Facebooks, the Amazons, the Zooms, and NVIDIAs, and all those kind of stay-at-home large tech giants. And we see it made a new high, all-time high yesterday. It is pulling back, but we are, let's take this open a little bit. We do see it's not perfect, but you could call it an ascending wedge or an ascending channel, where you see a very well-respected ascending support as well as 3 validations of an ascending resistance, creating a ascending wedge, and it broke to the upside, which means it's melting up. We could get a retest at around 10,500, which would validate the previous resistance as a new level of support in confluence with the ascending zone, which would create an opportunity where you'd be looking for moves to the upside as long as the risk on environment continues. So the NASDAQ still looks bullish, had a little pullback today, but pullbacks are inevitable. You want to understand the market structure, and in my opinion, the market structure is still telling me that the buyers are looking to enter. And I definitely do not want to go too early in the reversal, because this trend has been continuing to the upside for a while. And we like to continue the trend. Unless there's like major things that give us a market shift that would then change the trend. But if nothing's really changing and things are going according to plan, there's no real need to change our opinions, because our opinion is correct as of now. All right, gonna get a little bit of water, and then we're gonna jump right into the global markets, looking at the FTSE 100, the Nikkei 225, which is the Japanese stock market index, the DAX, which is for Germany, as well as the ASX, which is for Australia. All right, so we've been talking about this, page for a while, where we're looking at global indexes, and we're basically seeing a consolidation. And you could potentially form a descending triangle on this, or a symmetrical triangle, but it does look like buyers are still coming in and bidding up the price, creating a higher high. We see that in the Japanese stock market index. We're not really able to climb to a higher high, but for places like the DAX, which is the German exchange, we do see that we've broken the previous high and we're testing the most recent significant high back in early June before we had that little sell-off there. So it definitely looks like global investors are still seeking to invest in equities, and there's no major sell-off or shift in trend that would give me an indication that it's a very risk-off environment or will be a risk-off environment. So unless it drops, like for example, on the FTSE, it would have to drop below like 60, 70. On the ASX, it'd have to drop below 5,700, let's say. On the DAX, it would be like 11,700 or 11,770, somewhere around there. But a lot of these are looking like very similar structures, and we're not going to be trading them, but it gives us a good understanding of how global investors are viewing the markets. If they're buying, obviously a potential risk on sentiment where they're all right with the risk tolerance, and if they're exiting equities and going into things like cash and bonds, obviously that's an extremely low ROI or actually losing value, but it's going to be less risk than keeping your money in equities. So we're seeing the capital flows in the global macro environment, and capital flows right now are still funneling towards equities, it seems like, or other risk on instruments such as equities. So now that we're completed the equity side of things, we're now going to go into the US dollar currency index and quick look at the bonds here, except this is the primary focus of this page is the US dollar currency index. So we did move to the downside. We're retesting the previous resistance or previous support back in the structure as a new level of resistance. And we also see a series of lower highs get tested like so. So it's definitely still more sell pressure than buy pressure in my personal opinion for the DXY, which is weakness for the US dollar, which is overall risk on sentiment. Capital flows into the US dollar when there's fear, uncertainty, because it is the world reserve currency. And we saw it happen in March, early March, when there was that liquidation event. Gold, silver, equities across the board, crypto all fell. In what rose? Not many things. Bonds rose, US dollar, JPY, and other safe haven currencies. Other than that, basically everything fell. So we know that if there's a major market meltdown, US dollar will do well, will be receiving a lot of bids. Not a guarantee, but a high probability. But as of right now, it's definitely very weak right now. We just broke in market structure, resistance or support to resistance in line with the ascending wedge break to confirm the break in the ascending support. And now we're getting a confluent zone, not just for the horizontal and ascending zone, but also the descending zone as well. So in my personal opinion, dollar is going to continue to weaken. Unless it starts trading within that range, and then the main breakout, it could consolidate here for a little while. I don't really care. The main thing is I'd like to ideally see dollar weakness. Now, if I'm wrong, if it does start to move to the upside, the breakout point in which we would have to consider dollar strength would be the break above 97.70. If it breaks above 97.70 and holds above that zone for DXY, I think there could be an increase in dollar strength, which would not be very great for equities, for gold. And well, gold, it might actually be pretty good. Gold and the dollar could rise at the same time, but it wouldn't be great for stocks. It wouldn't be great for crypto, in my opinion, if the dollar starts to really surge, because the only reason people are going to be rushing into dollars if there's worry, uncertainty, fear in the markets. So right now, it's looking pretty good for the bulls, the buyers, the risk on investors and traders, but we do have to keep in mind the other side of the coin. Not a whole lot of discussion for bonds, little bit of a move down in the yield, meaning there's a little bit more capital flowing into the bonds. Not a huge surprise since the Japanese, or since the stock market is kind of consolidating, a little bit moving to the downside. The volatility is increasing slightly. We can see that within the VIX, so it kind of makes sense that there's a little bit more capital flowing into the bonds because the markets aren't looking absolutely phenomenal right now. They're not at a brand new high. They actually made a lower high, just holding a nice level of support. So if the stock market does make another leg up, breaking that recent high to form a new high, I expect the US government bonds to go back up and capital flow back into the equities market. Not really going to talk about COVID deaths. And then we're going to go on to gold, silver, and the gold and silver ratio, and a little bit of crude oil. So gold took a pretty big jump today. Let's just, actually, let's look at gold first. So we were in this nice ascending wedge. I would ideally like to see it melt to the upside, is what I said last time, and it did actually break this series of higher highs. So I think we actually see a pretty strong move from gold here, where we just about hit 1800. This is 1800 right here, which is a very important zone for the chart. When we go back to, for example, the 2-day, we're really close to it. And if we go all the way back to 2011, 2012, so 2012, 2011, we see a lot of rejection around this zone, just under 1800, at around 1800, and then the next major zone is going to be around 1900, right around here. So we see that there's a pretty big gap here from 1800 to 1900, which we could capitalize on, but the first main target that we are looking at is around 1800, which we're basically at right now. So there's, I think, going to be some level of resistance around this zone, but because of this ascending wedge break to the upside, what I could potentially see happen is a melt up from this wedge. So let's get our, not medium, but thick. If the risk off sentiment kind of comes in and emerges at a rate that we're not seeing, you know, if we see a higher high and a higher low respect this previous resistance as a new level of support, we could see an increase in price, because this normally wedges are looked at as a bearish, or especially the ascending wedges are looked at as a bearish sentiment, but in my view they could melt to the upside. BTC did this exact same thing where we had an ascending wedge melt to the upside. We see 1, 2, 3 rejections, so we got a valid resistance zone and we got a very valid support zone. So we see the price make a higher high, breaking the resistance zone, and I think as long as we're above this resistance zone, and I'm going to move this up a little bit higher like so, I think we can continue to see some higher highs and higher lows for gold. I think it's going to even move up higher than where it currently is right now. When we get a little bit of a pullback to around 1790, but this was an extremely bullish candle which engulfed past multiple candles, and it's looking pretty solid. And especially with the central banks printing a lot of money, I do think that people are understanding that with the federal government, for example, in the United States, printing like 16% more money in circulation within the last quarter, I think it was for the number. People are worried about monetary expansion and devaluing of the US dollar, debasing of the US dollar, so gold and silver are going to be looking pretty positive in my view. So silver is my bet. I'm not in gold, I am in silver, and the reason why is because the gold and silver ratio look phenomenal. So we're not going to get into that right now. We will quickly talk about silver. So we had a nice symmetrical triangle, which was a great continuation pattern to the upside. We did have a pullback that was a little bit more significant than I would have liked, but it was still a solid retest of the previous resistance, which is now acting as a new level of support. We made an impulse move to the upside, testing this around 1836 range, made a small pullback, made a higher low, and now we're testing that same resistance at around 1830. So if that 1830 zone on silver AXG does break, I think we're going to get a pretty strong move to the upside here. And that's what I'm going to be betting on. And if that is the case, I can move that stop loss very close to that entry and basically take off a lot of the risk that I currently have. The stop loss was lower, but I did raise it to reduce my risk a little bit more on silver. But it's looking pretty great overall, and I'm pretty happy with the current structure with it. It would be nice if it broke 1830 because that would give me a little bit more validation and the bulls having a little bit more confidence over the bears. And for any short sellers on silver, I think that's going to be where a lot of stop losses are going to be placed, is above that 1831, 1832 range. So there may be a pretty big shift in confidence and a shift in trend for silver if it does break that 1830 zone. So in my opinion, it's looking very favorable for silver. Gold is really taking the charge, and we do see that the gold and silver ratio is coming back up to the resistance because gold is leading the charge right now. But I think that silver will follow, and this gold and silver ratio will come back down to maybe 95s or even drop lower. But in my opinion, the gold and silver ratio still looks pretty bearish with this ascending wedge or channel or bearish flag that is tested the support as a new resistance multiple times, and we're just waiting for that major market sell-off in the gold and silver ratio in order for silver to really start to rally. But that's my current structure. It's looking really good. The risk reward's phenomenal for silver, and overall it's looking pretty great in the metals market. Next thing we're going to look at is crude oil. So this is WTI, Western Texas Intermediate crude oil. And we see that we're just holding the 40-50 resistance, and we are creating these higher lows. So this could be looked at as an ascending triangle pattern. I kind of view it more as a consolidation sideways, but we are making those nice higher lows. So it does sort of characterize as an ascending triangle setup. When we do zoom into the smaller time frames, we do see that the 40-50 range did get broken and held on the 4-hour and 6-hour chart on the larger time frames. But on the daily, there is just a wick here, indicating that there is sell pressure at this zone, keeping the price below this area. But obviously, if this is going up, risk on environment, people are using oil, people are producing products, people are using tires and plastic and all that stuff that oil is used for, transportation, which is growth and economic activity, which is obviously risk on sentiment. And if US or if oil in general starts to collapse and move to the downside, there's less demand for oil, less production, less transportation, which is less economic activity, which is obviously a risk off sentiment. So right now, risk on sentiment, everything is looking groovy, everything is looking good. So we're going to continue with the overall trend. We don't want to assume that everything is going to be a reversal or anything. We want to continue the trend until things indicate to us that it's really going to be changing. And I do not see that indication just yet. I do not see major indexes, major assets shift in trend just yet. So I'm going to continue on with the overall trend because obviously trend trading is pretty powerful, and I prefer that to always looking for reversals. I don't think that's a very good strategy, but everyone is different. Everyone has their way of managing their trades, managing their portfolios, so I can't say one thing is better than the other. So that's going to be the global macro update. A little bit less risk on, like the past few videos have been extremely risk on, where S&P is really moving to the upside and there's not a lot of worry for global investors, it seemed like. But right now it's a little bit less risk on. The VIX is moving up a little bit higher. It's still definitely risk on, but you know, there's a little bit of worry. The Russell 2000 is really squeezing in, so I think we're going to get a pretty big move here soon to come. If it goes up, definitely risk on. If it goes down, got to be a little bit more worried. But as of right now, there's nothing to really go off of that we haven't talked about within the past few days. So I still have the same trades on. They're looking pretty good. So I'm going to continue just holding on and doing the same thing that I've been doing because it's been working. So can't really, don't want to fix a wheel that's not really broken, I guess is a good quote. That goes something along the lines of that. All right, so I'll keep this on the S&P, and then we'll see if it holds this nice little support zone. And we're now going to go into the realm of crypto. If you do have any questions within TikTok or YouTube, definitely don't hesitate to ask. We will be going over questions. But for now, we will look at BTC and ADA Cardano, which hit our TP pretty swiftly, pretty aggressively, pretty strongly. So that's a great overall trade for us in our books. All right, so BTC is still holding the symmetrical triangle, consolidating between a series of lower highs and higher lows, funneling towards the apex of this squeeze. And the price is currently right at the resistance zone right now. Hence, I kind of took off a little bit of ADA, and things are looking a little bit less risk on. I do have a little bit just to let it run, but I do take the majority of my profits because I do like to set targets. with really solid risk rewards, which is always a good situation. So right now what we're seeing is the price is holding a minor level of support right around here. If we're just moving that down a little bit, but we're just consolidating. So in my ideas, or not in my ideas, in my view, Bitcoin is kind of in a no trade zone where unless you're like a very short-term day trader and you're able to profit off of these 2% moves, if you're leveraging like 2-3 times, that's definitely worth it. But in my opinion, it makes sense to look at more volatile trending altcoins, especially when there is a sign or signs that the altcoin market is looking more bullish. So right now I'm just waiting for BTC to do something. It's in a consolidation, and we've already talked about the reducing volatility and the reduction and the contraction of volatility, and how we look at that and take that as important information on what we should be waiting for. So when there's a major contraction in volatility, I personally wouldn't want to trade in that major contraction in volatility. I'd rather go trade other markets, other assets, and wait until the expansion and volatility starts. So what is that? This is a great chart for it, and you might not understand it, but we do explain this very in-depth in Performante Premium. We see that there is decreasing volatility in BTC below our significant 4.5 range. We can see that right here in the horizontal zone. The past 2 times we went under the 4.5 in volatility, we then had an expansion in volatility, creating a huge move with awesome risk reward parameters. So in our opinion, what we're hoping for is for the contraction and volatility to continue for ideally a little bit longer until there's going to be a major move, either to the upside or to the downside. We're going to trade it using just reactionary action. So we're not going to assume that it's going to go one way or another due to our analysis. We're going to wait, stay patient, and let the market tell us which way it's going to go. We don't need to be the first one in. What we're looking for is for that first major impulse push in either direction, and then we're looking for continuation patterns to carry the momentum. So right now we're contracting in volatility. Let's say, for example, we break to the downside. We don't need to be the first one in the trade. We just need to be looking for continuation patterns. If it breaks, for example, the 9K zone maybe around here, or the 8.5K zone, or 8.5K zone somewhere around here. We're looking for continuation patterns once the momentum tells us that the bears are starting to try to move to the downside and gain confidence. Right now, we're just making noise, up and down, up and down. I don't love trading it. I'd rather look for something that is a lot more trending, like Cardano, which we talked about within the Performante Premium subscription service. So that's my view right now. I don't want to be in BTC both long and short, or both long or short. I'd rather be looking for trending alts that provide a better quality setup in my personal view, and I'm just going to stay patient on BTC and wait for the big move to come before I really start to take any trades on BTC. The volatility is contracting. I don't want that. I want to be an expanding volatility when the market is moving exponentially towards one way or another, and I want to be on that side of the trend, right? That's what I'm waiting for. So now that we talked about that, we can quickly look at the reasons why we are looking at the altcoin market. One of the reasons is because of the BTC dominance. It is dropping. It broke the ascending support zone. We could see a support hold, but as of right now, it is going to the downside, meaning BTC is decreasing its overall market cap percentage of the total cryptocurrency market cap. So right now, BTC counts for around 64% of the entire cryptocurrency market cap, whereas let's say in May, it took 68. So BTC is taking less of the market cap, which means that capital flows are coming from Bitcoin to these alts, which means that investors in the crypto market are all right with higher risk tolerance and are willing to speculate on more volatile tokens, coins, projects. And that's when we start looking for relative strength, weakness, and we want to see relative strength in the coins that we are longing. So we've already talked about the coins that we're looking at multiple times in these videos. ADA is a great example. Link was a great example. And VeChain, which we talked about in yesterday's Performante Premium update does have relative strength as well, which we won't go over because that's just for the Performante Premium individuals. We are creating an altcoin market analysis quite frequently, at least twice a week, to go over relative strength and weakness within the cryptocurrency market and what opportunities are present in those coins. But one that we did talk about is going to be ADA, which is Cardano. So we looked at this, I don't know why that's there. We looked at this when it just broke to the upside, breaking this key resistance at around 0.09. And we were looking to enter on the retest, which we did. And then our stop loss was below that massive wick to the downside. And this was our take profit. So it had great risk reward parameters and it hit without a problem. Great overall trade. Nothing more to say on it. I do have a little bit of profit left if it does continue to run. But great trade overall. And what we're going to be looking for is more continuation patterns like this. And we can see it has had, this is not as great because it's a pretty wide resistance zone there, and it did cross that zone. But this was, in my opinion, a pretty pristine, perfect, beautiful symmetrical triangle that played out literally by the book. This could not be a better symmetrical triangle turnout, and we're very happy about it. And the Performante Premium students are sharing in the profits, which is always a great thing. So that's basically it for the crypto market update. We will notify the Performante Premium members of the current altcoins that we are looking at, but right now it's consolidating for BTC, so we're just focusing on the altcoins that have extremely strong relative strength compared to most of the alts that we are looking at that are available to trade on Binance. So thank you very much for coming in, listening to the global macro update. That's going to be the end of this video. I will close the recording, but I'll open it up at the end of the video for any questions that people have. If you want to answer, or if you want to ask anything involved in the markets for equities, for commodities, for crypto, we do cover all those. So definitely don't hesitate. But until then, I will end this video. And thank you very much for watching. If you found this useful, educational, informative, it would be great if you would subscribe. It does help out our channel greatly. And if you think that this channel could be benefited some way by some sort of constructive criticism that you may have, or if you think that this video or channel could be improved in some way, shape, or form, definitely put a comment down in the section and we will consider any alternatives or any add-ons that we can put onto these videos to make it a little bit more engaging or interactive or educational, some way, shape, or form. So thank you very much for watching. Hopefully you have a good day. Until next time, have a good one. All right, so that's the end of the video. So Dai said, hi, I purchased NIO at $5 and sold for $13.50. NIO. NIO stock. Let's look at this. This is a Chinese company. Yeah, so it's definitely, we already talked about China earlier in the video, but they basically told people through their media to buy stocks. There's going to be a stock market rally, so buy stocks. So the Chinese stock market index, or the composite, absolutely mooned. It's over like 10% right now, and you can see that with the video that we did at the start of the video. But there's a reason why Chinese companies are absolutely ballooning right now. Is China has their own form of stimulus, and that is government media notifying citizens that there will be a stock market boom, which then incentivizes investors in China to inject capital in the markets, creating more bids, thus creating more appreciation for companies like NIO. So it makes sense. Congratulations for basically almost tripling your money, or like 2.5x your money. So huge congratulations for you, Dai. Hopefully you don't spend it all in one place if you are going to take it out, and if you are growing your account, hopefully you are managing your risk so that stays in your account and it grows over time. So not much more to say on it. I hope that everyone's playing it safe. Just going to close some of these stuff here, and I hope everyone is having a fantastic day. I don't really see any more comments coming in, so I'm going to close this stream off. Really appreciate everyone for coming in and giving their 2 cents You know, I really appreciate that. And if you have any questions, we will be doing this every single weekday. So tune in next time, and hopefully I'll see you then. Till next time, have a good one.